everyone, and welcome to our weekly review of our risk model. As you can already see on this first chart now, our risk model rating is deep red. There's really a very high risk in the current market environment. And today we're going to spend some time to discuss the most relevant indicators in our risk model, and I'll explain why. This is really not a good market environment for us as swing traders. Let's start with some of the technical indicators, and for that I'm gonna jump in the trading view chart here. So the first relevant indicator that we're going to look at is the distribution day count. Now, distribution days are days which are down versus the previous day on a major market indicator by at least 0.2% on the elevated volume. Let's jump here. So that needs to be under elevated volume. Let's just pick this one, indicated with this little red arrow pointing down. This is one distribution day. This is under elevated volume versus the previous day, and is down at least 0.2% versus the previous day. Let's jump back. So if we look at the distribution day count of the major market indices in the US stock market now over the last, this is a relevant period, is 25 trading days, is 1, 2, 3, 4, 5, 6, 7, 8 for the Russell. For the Qs now, it's 1, 2, 3, 4, 5, 6, 7, 8, 9. It's 10. So we can even stop here now, because in a good market environment, you would not see more than an average of 3, potentially 3.5 or 4 as a maximum average for a good market environment. So this is a distribution characterized tape, if you will. And then it itself says now we are basically in a significant market correction here. So that's the distribution day count. That's why distribution day indicator in our risk model is deep red. The next one is the new, let's put this up, is the new 25-week high versus lows. Now we're always looking at the last couple of trading days, and here you can see the new 52-week lows, characterized by this red bar here, significantly higher than the new 52-week highs. There's number of stocks in the Nasdaq, on the Nasdaq listed markets, so that's deep red as well. The next one, let's put this up nice. What we look at is the number of stocks that are above or below their own 200-day moving average. So what we want to see for this indicator, first of all, in the ideal case, in a good market environment, this trend line is first of all higher than 50% and is trending upwards. So what we have here, this line is trending downwards, and it's below 50%, which means we have much more stocks trading below their own 200-day moving average in the current market environment. So you can say there's no breadth whatsoever in the current market, which makes it really difficult to gain any traction whatsoever for shorter-term swing traders at the moment. Next indicator is also deep red, is the up and down volume. It's the up and down volume of stocks for the diamonds here. So the up and down volume, we ideally see that indicator higher than 1. First of all, we would like to see this trending upwards, and we would like to see this indicator be above its own 50-day moving average. So we actually see the opposite now. The up and down volumes is at a pretty low number of 0.35. It's trending downwards and it's below the 50-day moving average. So also this indicator is deep red at the moment. And the last one that we're going to look at is the advanced decline line. So that's a very valuable indicator. As long as this is trending sideways, it's okay. We ideally want to see its trend upwards. What you often see is that the advanced decline line would top before the major market indicators top. In any case, now this is trending downwards, which is not a good sign at all. So basically what we can see is all of the technical indicators in our risk model are deep red. But we also can look at this volatility index. So where we ideally see this volatility index now here in the low range of around 15, maximum 20. And we do not want to see these spikes towards this critical limit of 30. So now it's peaking up very close to this limit of 30, which indicates a high volatility in this market on top of the fact that we are in a market's correction at the moment. So this is another strong signal for us not to stay patient, just stay on the sidelines, be fully in cash and wait for better market conditions. Okay, so as discussed now, all of these technical market indicators, as just explains on this trading view chart, are deep reds with a high risk rating. Let's take a look at two contrary market indicators, which is the bulls versus bears and the market depth. Let's take a look at the bulls versus bears. Now this is a contrarian market indicator. Now what we would like to see is that the market sentiment is not bullish at all in this contrarian market indicator, and we would like to see this peak down, because then we have the highest probability of entering a very healthy market environment for swing traders again. So this was trending down. It was quite some time in this critical range of 50, 60. This is pretty high. We are now down to 40 now, which is good. We would like to see this go down some more. Now we'd like to, as swing traders, now we'd like to see this continue to have the best opportunities for a more stable environment again. What we also see, the margin depth is falling down. This is also good now, because when the market depth is that high, that's really in a very boiling hot markets. We have margin depths of higher than 50. And if you have that, now there's almost no cash left to enter the stock market. So what should it push higher now is then the next question. So this trending downwards is actually very good for us, because then we'll have enough room, we'll have enough cash available again for institutional and retail investors to put money into the stock market, which is a good basis for another leg up here. So these two indicators are a medium risk rating, and then what we also look at is we are not taking any trades over the last couple of weeks. Actually, now we're waiting in cash for much better market conditions, but looking at just the stocks on our watch list and how they performed, this was also very poor. So this is also a high risk rating. So again, there's no reason whatsoever to recommend taking position at this point by any means. Now let's summarize that. So next to the technical indicators now, which we just discussed, now our risk model is deep red. Obviously, we have the political concerning situation at Russia, stationing big troops near the border of the Ukraine, and having issued a list of demand items to the Western powers, which are pretty unlikely to meet. Now nobody knows exactly what's going on in Putin's head, what he's thinking. But if that situation at the Ukraine border would escalate, that would certainly also have a higher impact on the global stock markets. Then now for about 2 years now we're discussing coronavirus. It's going up and down. It's impacting market sentiments. So we're having positive and concerning news. So the concerning element would be that the Omicron variant is still spreading exponentially in many regions on a global basis. At the same time, the experts are getting more optimistic now because of the milder course of Omicron is one element of their optimism. The other optimism is basing on the fact that vaccination programs seem to do their job. So hopefully we transition in a period where we'll be able to better manage and live with the COVID virus here. Talked about the stock market when we looked at the big market indicators. So obviously we are what we would call a stealth correction. So nobody knows if we have already reached the bottom or if it'll continue for quite some more time. In any case, we are in the middle of a market correction, as you can also see in the risk model rating. So I have mentioned that before, just be patient, sit out in cash and wait for the opportunity, which for sure will come again. And we do have some initial signals now when we look at the contrarian market indicators that the market may set up for another leg up and hopefully provide us with a great swing trading environment very soon from now. Okay, so I hope that's helpful. I did not put out a watch list over the last couple of weeks because we did not take any trades, but as soon as the market environment is improving, I'll do an update of the risk model, and then in case of improved market conditions, continue to send out watch lists on a more regular basis again. Hope this was helpful. Thanks for now, and have a good week.